Hey everyone. Well, we are going to get started with our third masterclass of this series. And thanks so much for tuning in either live or on the replay. And yeah, so this is all about how to get started as a passive investor and understand this crazy world of real estate syndications. It's a lot to take in. We understand that. And truthfully, any new investment takes time and effort to learn and get comfortable in. And that's why we're doing this series, is to help people gain confidence and understand what this whole world is about. So I'm Sujata Shyam, and we'll get to a little bit more about me later. But first of all, this is a webinar for people who maybe they've tried to get into syndications before, but got cold feet. Maybe you have invested in syndications before, but realized like, oh no, I made a mistake. I wish I hadn't put my money in that syndication. Um, and you still kind of think, well, I think there's something there. I want to learn more so that I can feel better about my decision next time. Or perhaps you're just feeling overwhelmed by all of the information overload out there. I totally understand that. There's really a lot to learn and a lot of information out there, a lot of noise to sort through when it comes to the investing world. And we're here to be a voice of just helping bring some clarity to all of that. So, are you ready to? Today, we're going to talk about two of the biggest myths that investors have regarding passive investing, and that tends to keep people sidelined. And then the main part of the presentation is we're going to learn the 5 ways to put your money to work, or I'm sorry, the 5 ways that your money works hard for you when you invest in syndications. It's not just as simple as, oh, this is the cash flow and this is the gains. Yes, we put those out in every projections that we put out there because it's important to understand the cash flow and the gains, but understanding what's behind those numbers is even more important. So it's not as simple as this is the returns of the investment. It's understanding, well, why is my investment making these returns possible? And that will give you a deeper understanding of not only this asset class, but your ability to compare that to other types of investments, whether it's stocks or crypto or, what have you, gold, etc. So yeah, just a quick overview, those 5 ways that you make money in a syndication: cash flow, equity pay down, leverage, tax benefits, appreciation. And appreciation can be broken down into forced and market appreciation. So one of the biggest lies that investors tell themselves about investing in a syndication is that I have no control. And this is a mindset that keeps many investors on the sidelines. And we talk about this every masterclass because it is really important to just develop that mindset of actually you have a lot of control. You have a tremendous amount of control leading up to when you wire your money. And then, yes, at that point, you are handing over control to the sponsor to shepherd the deal and to execute the business plan and to refinance the loan and to manage the property and to dispose of the deal. So those are all things that the sponsor takes care of that you don't have to take care of. And they are in control at that point. But leading up to that point, there's a lot of control that you have. You have control over thinking about what asset class you want to invest in. Do you want to invest in multifamily or self-storage or assisted living or mobile home parks, or, some people want to invest in office or farmland, et cetera. There's just a lot of different asset classes out there. Really, there are. So you got to choose where you are going to invest, what asset class, what market you want to invest in, and who you're going to invest in. And you're going to vet the deal. You're going to look at what is this a deal that I want to put my hard-earned money into? And so it's important to kind of get out of this mindset of I have no control and put yourself back in the driver's seat of like, actually, I have a lot of control by where I decide to place my investment. And the next biggest lie investors tell themselves about syndication investing: I won't make that high of a return. So compared to what? Okay, so let's say you are a single family home investor, which many of us started out as, myself included. I flipped a house, I house hacked, I had Airbnbs. And guess what? All of those require my time and attention and energy and take me away from what I'm doing day to day. And I don't necessarily know when that's going to happen. I don't know when a maintenance issue is going to arise. I mean, of course, you can have a property manager, but even if you have a property manager, you've still got to shell out cash if a big repair needs to be made. And you've still got to figure out how to make your mortgage payment if there's a vacancy at your place. And so your time is valuable. And that's one of the reasons why I got into this passive investing, is because I wanted to have purely passive income. And this is the first way that I found that really provides truly passive income that doesn't require me to basically run a business. And yes, of course, we can always talk about the stock market. Stock market's, going bonkers. And, I have some money in the stock market, but we all know the stock market is volatile. And that's another reason why I like commercial real estate, because we have control and it's much more predictable. It doesn't move nearly as quickly. It's more predictable, stable. And I like having that as a huge part of my portfolio, because the returns are still very comparable. I mean, even in a really great market, I mean, you're not going to make more than 20% in the stock market year after year after year after year. So we're getting at least, if not better, comparable returns to the stock market, even in a bull market. And then if you look at the stock market over the long term, we definitely are able to beat that as long as the deals perform. And lastly, the stock market is, the price to equity, the price to earnings ratio is really high, which we're not going to talk about right now, but there's it's somewhat overheated in my opinion. So I'm not going to make that high of a return compared to what? Just ask yourself that question. Okay, so I'm Suja, and I am a full-time real estate investor. I've been in the syndication business since 2010. I used to work for institutional equity partners underwriting multifamily acquisitions. So I basically came from that world, the financial institutional world. And then I realized that actually our investors were banks and pension funds and life insurance companies, and they were making money in these syndications. And there was no way that I was aware of for individual investors to make money in that way. And here are these like big players, and this is how they're choosing to invest their dollars. I mean, there's lots of reasons they invested in this, but I was like, well, why isn't this available? And there's lots of reasons for that. Why isn't it available to the individual investor? Eventually, I struck out on my own, and I figured out that actually there are a lot of people who are figuring out how to invest in real estate. And to be frank, it's the wealthy people in this country are investing in real estate through syndications. And that's a huge way that they keep and grow their money. And it's an important part of their portfolio. And I believe that that should be available to the average everyday person. And through private placements, it can be available to the average everyday person. This is a really exciting time in the crowdfunding private placement world, because in 2012, things started to open up and we can advertise deals, et cetera. So there's a lot of momentum and excitement every day. More and more private investors are turning on to this idea of investing in syndication. So it's a really exciting time. And if you're listening to this, you should be excited. So I got into this because I wanted to buy back my time. I didn't like going to the office every day. It didn't feel like a fulfilling life to me. And I just didn't thrive in that environment. So I wanted to buy back my time and be in charge of my own destiny. And so that's why I got into real estate investing. I left my job when I reached financial independence at the age of 33 through building my own small real estate portfolio of Airbnbs and single family homes. And then I wanted to level up and I wanted to take the next step. And I did that through syndications. So a lot has happened since I started doing syndications full time. And, I done due diligence and properties, all over the country. I've started my podcast, visiting construction sites, holding investor events. It's been an exciting few years. And now we are at Lux Capital. We own 37 properties, 1,850 self-storage units, total portfolio of $132 million. And that is growing. And who are our investors? Well, we have over 250 verified investors and over 40% repeat investors. And that's something that I'm really proud of, because I really want to provide a good experience for people and to make sure people feel comfortable and want to come back and are happy with the service that they receive. So we're just starting this series, and we're going to have several different topics that we cover. Here are some of the ideas of things that are going to be covered in the future, which I'm very excited to go over with you guys. There is a lot to explore. We're trying to break this down into bite-sized chunks. So today we're going to talk about the 5 ways that your money works hard for you in passive real estate syndications. And before we get started, just don't forget, this is for education only. We're not offering you legal advice or tax advice. Make sure you consult your team. And if you feel free to ask any questions you want, and I'll be sure to let you know if that's a question I can answer, or if that's a question you need to go ask your team, your accountant, lawyer, etc. about. Okay, so and yeah, just so you know, we will be talking about tax benefits, but we don't include any tax assumptions in our projections because everyone has a different tax situation. And so it's something that each individual has to evaluate for themselves. But we do, of course, talk about it and explain it as much as we can. Okay, so let's get into it. Let's tackle the 5 ways to earn money in syndications. So the first one is the most simple. It's cash flow. We get money from the rents that come in, whether it's multifamily or self-storage or senior living, etc. Rents are coming in and we're able to pay for all of our expenses, which includes utilities, property management, our mortgage payment, our taxes, our repairs, our landscaping, et cetera, et cetera, et cetera. There's all these expenses that we've got to pay. And after that, you know, if it's a good property, which hopefully it is, there's extra money that we can distribute to our investors. And so a cash flow, so you're getting cash flow ideally through the life of the deal from day one. Ideally, that's not always the case if we're doing a development deal, but typically we're looking for cash flowing assets from day one. And so that's the most simple one. Okay, let's now go to leverage. So leverage, this is an important concept that is really specific to real estate. So let's take an example. For this presentation, we're going to assume a original purchase price of $10 million for, let's just say, an apartment building. So we say, okay, we want to buy this apartment building for $10 million. And we're going to get a loan for $7 million. And we have to raise the equity of $3 million to buy this property. We're going to keep this example super simple. There's a lot more, you know, you can have multiple loans and different tiers of equity. We're going to do the capital stack in a different presentation. But for now, let's just assume there's one bank loan for $7 million and an equity payment of $3 million. So we're going to do a business plan. We're going to execute that plan. We're going to raise rents, improve the property, maybe decrease expenses, and in general, make things work better at the property. So through that business plan, we will be increasing the value of the property, and we'll be able to, and we're going to go into more detail later, but just bear with me. So we buy this property for $10 million, we improve the operations, and after, let's just say 4 or 5 years, we are able to sell that property for $13 million. Well, in this case, we're not going to talk about, we're just going to assume simple numbers and not talk about equity pay down or what just yet. But we're going to be able to, we have to pay the bank back $7 million. So $13 million minus $7 million is $6 million. That's our equity now in the deal. So we just turned our $3 million into $6 million. So we literally doubled our money from 3 million to 6 million. Whereas the bank, they just still have $7 million down in that property. And so we're just, or not down, but they have $7 million in that property, and that's still what they have. So our equity grew double and their money didn't grow. I mean, of course, we're paying them interest and whatnot, but that's the business model. The bank lets us, even though this property only appreciated 30% from 10 million to 13 million, we doubled the value of our equity investment. So that's the basic concept of leverage. If there's any questions about that, please let me know. Wanted to break it down to a simple example so that it could be understandable on a basic level. Okay, so let's now talk about equity. I'm just gonna actually change this to equity pay down because I wanted to break it down differently. So equity pay down is when you pay down the mortgage during the life of the loan. So while we are making monthly payments, there's a principal payment and then there's an interest payment. And most people know that if it's like a 30-year loan, the principal payment is very low and the interest payment is higher. But still, the basic idea is that when you have a long-term loan, then you're able to pay the equity down over time. So the tenants are actually paying that equity. And so it might go down to after 5 years, it might go down to you might have paid down the loan by it might be like 6.5 million, for example. And so that's another way that we earn money with our syndication, is that we're actually paying down the loan. So we're capturing back some of this orange bar. Okay, so that's, and there's definitely some, exceptions to that. Sometimes we start with an interest only loan, in which case we're not paying down our equity. But just generally speaking, equity pay down is one of the benefits of real estate. Okay, so now we're going to talk about tax benefits. So this is always a fun topic, and it is very unique to real estate. The government, we like to think of the government as incentivizing us to do certain things in order to achieve tax benefits. So the tax code should be looked at more as an incentive code, where the government's saying, hey, well, we want you to build up our country, so we'll give you tax benefits if you invest in real estate. And that's one of the main reasons why real estate has tax benefits, is because the government has taken the position that in building up our physical assets, our built environment is important in real estate, and they want to incentivize that because it is risky on some level. I mean, if you don't know what you're doing, and obviously we're mitigating against that, but the government wants to incentivize it. And so they give us tax benefits for investing in real estate. So let's talk about the tax benefits of syndications versus single family rentals. So if you buy a single family rental, which is where a lot of real estate investors start, again, I started there, my parents started there, a lot of people start there. If you buy a single family home, that's a residential property, then you're going to be able to depreciate that home. Let's say you bought it for $1 million on a 27.5 million or 27.5 year schedule. Of course, you're going to be depreciating the building value, not the land value. But the point is that over 30 years, so let's just say the building value is $750,000 divided by 27.5, that's $27,272 that you can deduct off of your net operating income every year and not pay taxes, which is pretty good. However, with syndications, it gets a lot better, because with syndications, the properties are big enough and we can use cost segregation. And it's kind of a fancy term, but basically what it means is we take an engineer and we say, hey, break our property up into all of its components, whether it's the electrical system, the roof, the appliances, the bathtub, the flooring, the insulation, etc. And then let's put each of those components on a different depreciation schedule. So some components can be on a 5-year schedule, some can be on a 10-year schedule, and some can get bonus depreciation, which means that 100% of the value of that component can be depreciated in year 1. And so we depreciate. So oftentimes, we'll be able to take losses in the very year that we bought the property. So we'll actually get losses on our K1, and the K1 is the statement that you will get when you invest in a syndication. You'll get one every single year. And that K1, when it has a loss on it, it means that you can count that loss against other rental income property that you have or other passive income that you have. Again, make sure you talk to your tax person before you draw any firm conclusions about whether you can use the losses or not. For example, you cannot count losses against W-2 income, and et cetera. There's some other restrictions, but you can get losses in year one. So what does that mean for you, the passive investor? Well, it means that if you want to, it means that if you want to apply those losses to other gains that you have, passive activity gains, then you can do that. And that allows you to free up more capital so that you can make more investments. See, that's the whole mindset of being an investor. Is in real estate investors want to free up as much liquidity as they can so that they can make more investments. That's literally like the mindset of the investor, the real estate investor, encapsulated into one concept. Is we want to free up liquidity so we can make more investments and take advantage of the time value of money, because the value of $1 today is worth less than it is, or $1 is worth more today than it is tomorrow. For example, we had like 6% interest just in the last year. This is fall of 2021. So literally $1 today is worth like 6 cents less than it was worth a year ago. So so $1, so time value of money, and we can also invest that at, say, a 15% IRR and be able to grow that capital more quickly. When you look at compounding interest, and so this is where tax benefits tie into, like Albert Einstein. Albert Einstein said the eighth wonder of the world is compounding interest. Those who understand it earn it; those who don't pay it. And this ties into tax benefits very intricately, because the whole purpose of the tax benefits with real estate is to keep the liquidity for yourself now so that you can make more investments and take advantage of the time value of money. So that's kind of the bigger level concept of tax benefits and why that's such an important part of investing in real estate. Even though it's a little bit obtuse and hard to kind of wrap your mind around, it's something to keep studying and keep kind of keeping on understanding it as you go on. Okay. So now we're going to talk about appreciation. So appreciation, we're breaking it into forced appreciation and market appreciation. Okay, so let's talk about forced appreciation. One of the reasons why we like investing in real estate is because we're in control of the property. Like if you buy a stock in a company, you're not in control of that. Well, it's much more volatile. So yes, you buy a syndication, you're not going to be in control of it, but you can vet the business plan, and it's much less volatile than buying stocks. And like the stock market is obviously a lot more volatile. It could crash big at any point, and I just prefer not to be in that space. But so let's talk about not to be in that space in a big way. So let's talk about how forced appreciation works. So forced appreciation works. Let's go back to that example. We purchased a property for $10 million. And let's assume that at that time, the cap rate that we purchased it at was 5%. That means that the NOI on the property was $50,000. So, and how did we get that? Well, you take $10 million and you multiply it by 5% and you get $50,000. So net operating income, that $50,000 equals the total income of the property, all the rents and other income, like, for example, laundry income, reserved parking income, having valet trash, or there's all these different ways to have other income besides just what the rents are. So we've got $50,000 in gross income, and then we have expenses. And the only big expense we're not going to talk about right now is we're not going to talk about the mortgage payment, because when cap rate, we don't include the mortgage payment. And that's because people are going to have different ways of financing properties. And so we want to be able to compare apples to apples, one property to another property based on the NOI. And so we're going to do a whole section on cap rate, because there's a lot of details that you have to be aware of if you're going to actually use a cap rate. You can't just take a cap rate at face value. You have to understand what's behind that, because there's a lot of things that can be included or excluded, and it can tweak the numbers a lot. And so we're just going to assume that we understand what's all behind these numbers, and that we're confident in this 5% cap rate. So our value add business plan, we're going to increase rents after we, upgrade the property. So we're going to upgrade the property, make it nicer, maybe replace some appliances and upgrade units, make the exterior nicer, make it a nicer place to live, make it maybe install some barbecue areas and some playgrounds, dog park, make it just in general, take like kind of a rundown property and then make it nicer, more attractive, more pleasant to be in, more functional, and a better place to live, work, and play. So we're going to do that. And then because of that, we can increase the rents incrementally. We don't want to shock anybody with increased rents. And we'll also decrease expenses as possible. That's always something that, I don't necessarily like to count on too much, but, we do what we can to decrease expenses and make sure that the property is operating efficiently. And then, I mentioned some additional streams of income that can be added. And that allows people to just get the experience that they're willing to pay for. Like if they want to make sure that they have a parking spot in front of their house and right in front of there, and that they can count on, they might be willing to pay an extra $20 or $30 a month for that. So we're going to assume that we can increase the NOI by 30% over a 5-year hold period. So 50,000 times 1.3 is approximately 65,000. So we are going to increase the NOI over the course of 4 or 5 years from 50,000 to 65,000, which is, not too hard if we're going to be just hitting base hits. It's not like we're doing anything crazy. We're not doing any major rehabs. We're just simply making base hits all day long, something we can figure out how to do, and we will be able to increase. We're going to assume we can increase the rents to the NOI to 65K. Okay, so now forced appreciation versus market appreciation. So let's assume that the market's unchanged, that the cap rate is still 5%, that an investor is still willing to pay the same amount for the same income stream. So in that case, we've increased the value of the property to 1.3 million. How did I get that? I took $65,000 and then I divided it by 0.05. So 65,000 divided by 0.05. Feel free to do it with me on your phone or calculator. What do you get? $1.3 million. So in that case, if the market was unchanged, we increased the value of the property by 30%. And we doubled assuming we put $33 million, I think I might have like missed a digit somewhere in there. But in any case, I think I went from like, this should be 1 million. This should be $1 million. So yes. So we purchased it for $1 million. Sorry. Oh, I'm off by a digit, but the numbers are now correct. So we were able to sell a property for 1.3 million. So we increased our equity double if the market was unchanged. Okay. So let's say that the market got worse. We always want to plan for a worsening market and look at our, what do we think is the worst case scenario? And so if the market got worse, but we want to sell the property, then we're going to assume a 5.5% cap rate. So $65,000 divided by 0.055 is 1.18 million. So we still made $180,000 in this case, which is, still a huge increase over $300,000. That's still, double or increasing our equity investment by about 67%. And that's pretty good. If the market got worse, I will take that. Now let's assume that the market got better. So if the market got better, we're going to pretend that it's a 4.5% cap rate in 5 years, and we'll be able to sell the property by $1.44 million. So we took $65,000, that same new net operating income, and divide it by 0.045. So that's $1.44 million, which means that we more than doubled our money in 5 years, because we are going to assume we put in $300,000 of equity. We had a $700,000 loan. And so 440,000 divided by 300,000 is 1.46. So we more than doubled our money. And so that's pretty exciting. We took 300,000 and turned it into actually, okay, so let me just explain this again. So out of that $1.44 million, we increased the value by $440,000. And then we also are able to get our equity out of the property of $300,000. So 300,000 plus 440,000 is 740,000. So 740,000 divided by 300, which was our original investment, would be 2.46. So we more than doubled our investment by quite a lot if the market got better. Of course, we don't want to assume that the market's going to get better. We want to kind of know, well, what are the guardrails of our investment? What do we think the worst case scenario is? And what do we think the best case scenario is? So that's forced appreciation plus market appreciation. So for the forced appreciation is, we're just going to assume that the market's unchanged. If the market gets better, then through market appreciation, then we're going to do a lot better. And if the market gets worse, then we're still going to make money, which is exciting. I mean, can you say that for all investment types? If the market gets worse, you don't lose money. I mean, that's Warren Buffett's number one rule: don't lose money. So what I like about this is that in real estate, losing money is something that happens in certain situations. One situation is the person that you're investing with is fraudulent and not to be trusted. And so in that case, if you make a mistake like that, then that person can just it is possible to lose your money in that sense if you invest with a fraudulent person, which is why it's so important to make sure you trust and know who it is that you're investing with. But what's great about not losing money is that if things are going relatively smoothly, even if the market turns, we're actually still projecting that we're going to make money. So that's one of the reasons why I like real estate. The other reason why real estate deals go south is because of leverage. And I know I hammer this home almost every time I talk, but it's so important to understand, because this is why so many people were broken in 2008 and 2009, is because the leverage was not appropriate. They were over leveraged on their properties, and they could not keep, when the market dropped, and there are all these different things that happen, which I won't go into detail with right now. Properties were over leveraged and they could not make their payments. So they lost the properties. Sometimes some people were able to make it through, but you want to make sure that you have proper leverage. So if you control for those things, you invest with a solid operator who's trustworthy, and you make sure you have appropriate leverage. And then you also do various other control mechanisms, like make sure that you know what market investing in, the market, and you like the deal, you're not going in with your eyes closed. Then even if the market gets worse, we're still planning on making money. And so that's what I like about real estate. Okay, so just to recap, 5 ways to make money. We've got cash flow. I'm going to put equity pay down here. And then leverage, tax benefits, and appreciation forced, and market appreciation. So yeah, that is our presentation for today. We're going to go to questions, but first of all, if you are interested in investing, I want you to contact me. I'll make sure you have contact information. You can sign up right here, and we can have a conversation and see if anything that we have would be a good fit for you. So thanks very much. And just a reminder for those of you who aren't in the Investor Club yet, the Investor Club is for people who are just starting out. It's for seasoned investors. One of my major goals in this business is to close the investing gap. It's so important that every single everyday person starts to learn how to get in control of their finances and learn to invest in high quality in asset classes like commercial real estate. So this is for you, whether you're just starting out or whether you are a pro at investing. These deals are excellent deals for people who are seasoned real estate investors. And yeah, this is for people who are doing this on the side or doing it full time. If you haven't done a deal yet, I'm definitely for you. If you've invested in several deals, I'm sure you'll be happy with our experience here. So that's who the Investor Club is for. And that's all for today. So now we are going to do some questions. Thanks so much. We'll see you next time.